Have you ever just looked at the stock market lately and thought, what is going on? This makes absolutely no sense. Well, you are definitely not alone. Today, we're going to jump into a huge online discussion where people are trying to answer that exact question, a real head scratcher that's on everyone's mind. Okay, so let's get right into the heart of it. We're all seeing the headlines, right? Inflation, chatter about a recession, all this global uncertainty. And yet, the market often seems like it's living on a completely different planet. We're going to dig into a few fascinating clues from this conversation that might just explain this bizarre disconnect. You know, this feeling isn't exactly new. As this one person points out, it's felt weird for a while now. But a lot of people in the discussion agreed on one thing. Right now, the gap between the real economy and the stock market feels more extreme than it's ever been. So let's unpack the first major clue they came up with. So what's the first piece of this puzzle? Well, it's a big one. It's this idea that the market just isn't playing by the old rules of risk and reward anymore. And why? Because there's this powerful, unspoken belief that it will never be allowed to truly fail. This comment right here, it just hits the nail on the head. It's suggesting the game isn't really about a company's profits or how the economy is doing anymore. Nope. It's about guessing when the government or the central bank is going to step in and save the day. The market basically is running with this built-in assumption that someone will always be there to catch it if it falls. So what exactly is this safety net? Well, commenters pointed to a few key things we've all seen happen. We're talking about massive corporate bailouts, where the government just swoops in to save a failing company. Then there's quantitative easing, or QE, which is basically the central bank printing money to pump into the economy. You've also got direct government subsidies to industries, and of course, that overarching idea that some companies are just too big to fail. And boom, this comment just perfectly captures the mindset that's been created. Think about it. Past crises, like the pandemic, taught the market a really powerful lesson. When things get truly terrible, help is on the way. That kind of conditioning has totally changed how investors look at risk. Okay, so if the market expects to be saved from any huge collapse, what's propping it up day to day? That brings us to our second clue from this discussion, and this one points to a massive, non-stop flood of cash getting pumped into the system. And this is the crucial point. We're talking about a staggering amount of money, what the experts call liquidity, that's been injected into the economy. All that cash has to go somewhere to get a return, right? And the stock market is one of the only places big enough to soak it all up. And when that happens, it just pushes prices up and up, sometimes whether a company is actually doing well or not. So when we say liquidity, what do we really mean? Here's an easy way to think about it. Picture a bathtub. If you just keep turning the faucet on full blast, the water level is going to rise. It doesn't matter what's actually floating in the tub. In this case, the water is all that cash, and the bathtub, well, that's the stock market. Now, this tidal wave of money isn't just coming from one place. The folks in this discussion pointed to a really potent mix. You've got the central bank printing money, sure, but you also have the steady, automatic flow of cash from everyone's 401k plans, that little bit from every paycheck that just goes right into the market. And on top of that, direct government spending that eventually finds its way into stocks. It's a combo deal. And just to put a number on it, one person estimated that just the automatic 401k money alone pumps somewhere between $10 and $20 billion into the market every single month. I mean, that is just a relentless, powerful tide of buying pressure day in and day out. So we have a market that thinks it can't lose, and it's being flooded with a constant fire hose of money. How does that actually change how people behave? How does it affect the investors? Well, that brings us to our third clue, and this one is all about psychology. I love this. One user came up with the absolute perfect term for it, Invincibility Syndrome. It just captures the whole mood perfectly. For more than a decade now, almost every single time the market is dipped, it's roared right back. And that has trained an entire generation of investors to see any downturn not as a sign of danger, but as a can't-miss sale. And here's the kicker. This whole mindset becomes a self-fulfilling prophecy. I mean, think about it. Why would the market ever truly crash if every time it even stumbles, a giant wave of buyers rushes in thinking they're getting a bargain? That behavior props prices up and reinforces the belief that there's no real risk, which just keeps the cycle going. And others in the discussion felt the same way, just maybe a little more bluntly. They feel like the market's behavior has completely broken away from any kind of rational thought. It's this feeling that pure momentum and emotion have taken the wheel, and the old school ways of valuing a company, Looking at its profits, its debt, what they call fundamentals, are almost irrelevant now. Now, beyond just mass psychology, some people pointed to something more deliberate, outright manipulation. And two main theories kept popping up. The first is that super-fast trading bots run by AI are just reacting to keywords in the news, causing these huge market swings without any real human thinking behind them. And the second theory? It's a classic, that it's all just insider trading by powerful people rigging the game for themselves. All right, so we've looked at the clues. This belief in a permanent safety net, a flood of artificial money, and this psychological invincibility syndrome. So what's the final verdict from this whole conversation? And maybe more importantly, what's a regular person supposed to do with all this information? The big takeaway, the consensus really, is that the market is running less on fundamentals, things like profits and economic health, and way more on pure speculation, momentum, and this constant expectation of future bailouts. It's a market driven by belief, not by balance sheets. In the middle of all this chaos, one user offered this really simple, really practical two-step playbook. The idea is, instead of trying to outsmart a market that seems totally irrational, you should focus on what you can actually control. First, they said, invest in index funds. That way you're not betting on one single company, you're just buying a tiny piece of the whole market. And second, and this is so important, set your limits. Decide beforehand how much you're willing to lose without freaking out and panic selling. And that leads us to the final, lingering question that this whole discussion leaves us with. If prices seem totally disconnected from actual value, at what point does it stop being investing and start being, just gambling? It's a deep question, there's no easy answer, and it's definitely something to chew on long after this is over.